3, 2, 1. Shit. Hello, good evening. Good evening, folks. How's it? Hello, Jacqueline. Good evening. Boyza, how's it? Kunta, Mornay van Rooyen, goeienaand. Welkom aan julle mense so lank. Ek het verskriklik gery en gejaag om hier so aan te kom. So ons hoop hier so gaan nog 'n paar mense ons join en dat ons vanaand 'n lekker chit-chat gaan hê met betrekking to everything and anything. So if there's any questions, please pop them in and let's start. Kunta, thank you, mate. I am pretty well. Running around big time. Life is good. Really can't complain. Hi, Jacqueline. Wave back to you as well. Good evening, Mark. And goodbye, Mark. That was a quick one. Good evening, Max. Welcome to you, Shano. How's it, folks? I hope that you will have a couple of questions for us tonight. So pop in. What would you like to know about planning? Planning for your future, planning for your children, planning for your estate. Retirement, investments, you name it, you can pop it and we can talk about it. Oh, thank you very much, Max. Yeah, the beautiful view in the back is actually from our living room. And yeah, bought this house many years ago. Was a little 2-bedroom house that I've had many years to do, but up still my very happy place to come home and spend time here. And yeah, we really do enjoy the view, I must be honest with you. It was better years ago. Now across the street, so to speak, they have built up a number of shopping centers and complexes and everything. So yeah, it's taken a bit of the scenery away, but still it's lekker. I've learned a lot from you. Keep up the good work, my brother. Thank you. Tapskizo. I hope I'm pronouncing that right. 100%, mate. I will try and do my best. Okay, so is there anything that I can tell anybody at this stage? Is there anything specific anybody wants to know that we can start with? Sasa? Sasa just joined. I hope it's not the government, Sasa. Skyfie, hey hoe gaan dit oom? Skyfie, het gaan baie goed om water, baie dankie. En hoe gaan dit met jou water? En ja, let's see if anything. Hey, come on folks. You know there's a Q&A, eh? You have to ask questions for me to answer. Hope you didn't have any Nvidia stock. Max? People are worrying too much about something like Nvidia. If you are a shareholder in Nvidia, if you are a shareholder in Nvidia, yes, then you have taken some suffering in the last day or two. But if you are invested in a portfolio in any form of investment, be that in a unit trust, a life investment, a retirement annuity, where in your portfolio they have NVIDIA, the chances that you're going to be hurt is very small, because the chances are very likely that there's not more than 1 to 3% of the entire portfolio invested in NVIDIA. So yes, NVIDIA has had a bit of a hit. Don't know if they're going to recover, but not too bad. Skyfie, ek weet is jy om water. Ek weet is Fransjo Junior. Welkom hierso. Ja. I checked DeepSeek regarding my financial short-term. Amazing response. Check it out. I've actually heard about DeepSeek and I actually want to still go and look at it. But then at the same time, there's 110 other apps that I still want to go and look at. There's these days so many AI apps that one can use for all kinds of things. So yes, I still want to go and look at DeepSeek. There's so many people that keeps on talking about it, or that keeps mentioning it, although nobody has actually told me or explained to me exactly what it's about. So I think I'm going to make a note now. Seeing that you've just mentioned it, maybe I should just go and make a note here on my to-do list that I can go and check out what DeepSeek is all about. So let me just put it in here. What is DeepSeek all about? Definitely going to check it out when I've got a chance. Oh, I don't trust DeepSeek at all. It senses anything about Taiwan or the CCP. Okay. Max, I won't know once again. To be honest with you, you know what? In South Africa last year, the POPI Act was brought into play, or maybe it's 2 years already. I'm not even sure. And there's so many people that worries about their personal information, this, that, and the other. The world has evolved so much. If you are on social media, if you have a telephone, a cell phone, you are constantly being tracked, monitored, information is being gathered. To me personally, you have to be a CIA agent or serious corrupt criminal that finds out about all this stuff to stay unnoticed in the world. So my personal opinion is, as long as you go the straight and narrow, so to speak, if you are walking the straight and narrow path and you are not criminally activated or anything to that extent, then you don't have to worry. People want to see what my name is, my ID number, where I stay, whatever the case might be, then go for it. There's plenty of places you can get it. I don't need to hide from anybody or anything. So yeah, I must be honest here. I don't really care about that if they do censor and if they do check stuff. Let's see what else. Eufred, good evening. Richard, how's it? Murida, good evening. Come on, folks. Give me a question or two here. There we go. Hey, my good friend is back. Mr. HB, I think it is. When retiring, can I choose to keep all my funds in the same retirement fund of my company? It depends. And when I say it depends, is there's some pension funds, some companies like Sentinel Fund, for example, which is a mining pension fund. And they have the option that when you retire from them, you leave your funds there. But it's because they then offer specific benefits. They offer a specific income, a specific guarantee, specific rules. So then you can leave it there. But if you are invested in a out and out defined contribution fund, where your money is just invested in a fund where it grows depending on how well or how badly the portfolio is doing, then the chances that you can move it to that company is very small. You most probably going to have to move it because they are creating that pension fund purely to give their staff and their employees a pension fund in order to retire from. They don't want to be involved after retirement with your stuff. They don't want to have the hassle of the administration and everything like that. So it depends on the company that you're with and how their pension fund is structured, and if they have input in that pension fund and it's not all part of the outside administration company. So yeah, it really much depends. But most pension funds in South Africa unless it's one of the big ones, big companies, or big banks, for example, big insurers, big mining companies, you're most probably going to have to move your stuff out of there. Okay, Eufred, first time here, hearing you talking about finance, best way to save for a car for a first time buyer. Eufred, okay, that's most probably one of the most difficult ones to answer because it depends on what type of car you want to buy. If you are thinking of buying a small car, and it's not going to take too long to save up for it, and let's say you want to buy a car that's worth 100,000 Rand and you can put away 10,000 Rand a month for argument's sake, then I'll just go and push it into a bank account, because the interest that you are going to get on it is not going to be so great that in 10 months that you put in 10,000 Rand, you get to 100,000 Rand, you're suddenly going to sit with 150,000 Rand. But if it's a different situation and you are going to save 1,000 Rand a month, but you want to buy a 400,000 Rand vehicle now, then I would say it's most probably going to be better to make use of a unit trust investment or a life investment where you will get substantially better growth than what you will get in a bank account. And because you're putting away 1,000 Rand per month, you have to save for a longer period of time. So you will build it easier and faster there in that way. So it depends on how long your time frame is, how much risk you're willing to take, and then when you want to buy this thing. And taking this simple example that I just used, if you want to buy a car that's worth 400,000 Rand today, and you go and calculate how many years you have to save in order to buy that vehicle, you're most probably going to find that's going to take you 4, 5, 6 or longer years. If that is the situation, you might have to start preparing for that vehicle to be 600 or 700,000. So I think your time frame and the amount that you can put away per month has a big influence on it. But one of the most important things to do is, if you're going to save for this car and you're going to set your goal on a set amount, then sacrifice. And as you get extra money, if you get a couple of $100, a couple of $1,000 extra, don't put it in your investment. The more you push that investment, the quicker you will get to your target. And that at the end is the idea, is to pay off the car. I have a flat with levies going up all the time. The rent is also put up, but is it wise to keep? Rian, I have spoken about property on a number of occasions. I'm not the biggest fan of property. I must be honest with you. Property, there is some people that do fantastically with property. So I think property is a pretty risky investment. Risky in the sense that you have to find a good renter. You have to find somebody that will keep on paying you. You will have to find somebody it's not going to break down the place. You have to look after the maintenance. You have to do the administration. You have to manage it. So there's a lot of external factors that can make a flat and the renting of a flat a high risk. So here it is. Some people that I have spoken to are very lucky. They have got houses or flats or whatever the case might be, townhouses, and they've always had good renters. And because they've had good renters, it's a wonderful investment for them. But then there's a number of people that exactly the opposite happens. As a matter of fact, on my way home this afternoon, I spoke to a long-standing client of mine that's always been into property. I've done some retirement annuities for him. I've done some life cover for him. But I've never done an investment for him because he's always been of the opinion that properties is best. And now we are 15 years down the line, and now he's decided, listen, yeah, I've had so much pains with people renting and with the upkeep, and now with rates and taxes going up, and now that they've gone and they've recalculated the return of investment, he's actually calculated that if he puts away what he is contributing towards his bond repayment on a monthly basis, if he contributes that to a life investment that only gives him a 7% return on investment, only 7%, he has calculated that in 10 years, he will make substantially better return on investment on that than on his properties based on how his property experience is currently going. So there you go. There's risk in every investment. That's what one has to understand. Now, based on just what he said, If his return on investments of only 7% over 10 years, man, then he should have been invested, or he should be investing in a investment like I always talk about, the life investments or the unit trust investments, where you can get with very easy, get a 7 to 8% return, not taking high risk, and not having any of the headaches. Not having any of the headaches that goes with the management of property. I've also had a number of clients already in the past that tried to build up property portfolios, and they made use of this thing that's always advocated. Go buy a property, have it reevaluated, get a second bond, buy a second property, keep on reevaluating, pushing up the values, and buy 4 or 5 properties. But it's all reliant on you've got renters that's paying the rent, so that you don't have to do the bond repayments. And all of these clients, and when I say I've had a number of them, there's at least 5 or 6 of them, actually went bankrupt because it didn't work. So I will always, and I will not step away from this point of view, be of the opinion that the only time that the property is an asset is if you could buy it and pay it off cash, either immediately or in a very short period of time. Because it's only when that property is paid off, and you don't have to worry whether you're actually getting rent, where you don't have to worry about your renters stuffing up the place. That's the only time it's an asset, because you know it's standing there. Yes, you have to pay a bit of rates and taxes, but it is not unmanageable, and it doesn't hurt your cash flow that suddenly you've got 3 months that you have to cover the bond, which you were not prepared for. Okay, so let me see. What's next? Okay, let's see. HP, thanks. Pension fund. It's with Alexander Forbes. Wonder if they do living and life. Yes, Alexander Forbes does. So if the pension fund is with somebody like Alexander Forbes, it's a defined contribution fund. Therefore, you can leave it with Alexander Forbes. And sorry, I misunderstood you. I thought when you said leave it with your company, I thought you're working for company XYZ. Must you leave it with company XYZ? No, if you're talking about the administrator like here, Alexander Forbes, you can keep it with them. You can do the life and living annuities through them, or you can move it away. It's your decision based on the advice that you get and what your needs are. Fred, thank you. As a business owner, what is the best way to create a salary for myself? Speak to your accountant, Fred. Speak to your accountant. That's why accountants are there. They're the guys that knows how to work the figures. And then a second thing is how to create a salary for yourself is go and read books on business. And I'm not just talking about business books, about economics and stuff like that. Go and read stuff on discipline, goal setting, motivation, those type of stuff. And you will get out of that more than enough stuff to understand how to do this. Business owners normally take very little salaries, draws very small salaries, because the business takes care of a lot of their expenses. But that's where it's important to speak to an accountant that can help you to manage your books and your incomes and expenses, because you want to make sure that you get the best possible benefit from a tax point of view, in terms of personal tax, company tax, if there's dividends or profits to be declared, that you get the best from that. So get yourself an accountant. Accountants, especially if you get one that's good, is worth their weight in gold. And I know as a new business owner, I went and I made the same mistake. As a new business owner, I operated for about 2-3 years, not making use of an accountant because I didn't want to pay somebody. And when I eventually started paying somebody, then I realized, listen, mate, you should have done this from day one. You would have paid him for his services, but you would have saved yourself a lot more on the headaches that goes with it. If you don't have a good accountant, I know a very good one that is very reasonable, and I can point him in your direction. If I save 18,000 Rand a month, should I put this in the ETF or buy stocks? If so, which stock? Mapulana, I'm glad. Thank you very much for liking my videos. I appreciate it. I cannot, and I've said this many times, and I'll say it again. I cannot tell you whether you should buy ETFs or whether you should buy stocks, because I don't know how old you are, how long you have to invest for, what your income is per month, what your assets are, what your liabilities is, what your financial dependents are, how much risk you can take. The only way to inform somebody or tell somebody is to consult with them and then give them advice based on a consultation, because every individual is different when it comes to this. For some people, ETFs and stocks might not even be a consideration because they have not made use of the tax benefits they could get from a retirement annuity. For other people, a retirement annuity is not even in the picture because of their setup. For some people, ETF or stocks is not even a consideration because they want something that is going to be higher return than potential stocks. See, the thing is also with stocks, and this is, I think, is something that people always lose out of the equation, is what stocks are you going to buy? If you're going to buy a blue chip company stock, you are buying a stock, you are buying an equity or a share that you are going to hold on for a long time because it's a blue chip company. They're not going to shoot the stars out to 20, 30, 40% return on investment on a yearly basis. But if you are going to buy a new company that comes into the market, and that new company is going to do well, that company might be doing 20, 30, 40% as a new company, maybe with a new product, a new concept, whatever the case might be. Everybody is excited about it. But at the same time, that same company can fold and your money is gone. So when it comes to stocks, you've also got high risk and low risk stocks. So it's difficult to say. ETFs, I've never been a big fan of ETFs. ETFs, electronically traded funds, it's a computer generated system that follows a specific trend or follows a specific stock market or whatever the case might be. I prefer actively managed funds where you've got a portfolio manager that can use his common sense, his brains, all the input he's getting, all the research he's done. He can make decisions as to what to buy and to sell there. And I know why people make use of ETFs, because they think the cost is so much lower. You'll be surprised when you go and actually have a look and you compare ETFs to portfolios. How many ETFs are actually more expensive than portfolios? But yeah, let's not go there. I need to separate my personal finances from. Yes, you Fred, once again, mate. That's why I say make use of an accountant. You are not going to regret it. You will, if you get to the right accountant, they will help you to structure your company properly, your personal incomes, expenses, everything, VAT, tax. So yeah, to separate that stuff, definitely an informed accountant. Okay, let's see. Kitso, what's your philosophy regarding investing? Okay, so this is an interesting one because my philosophy is that one should invest for a long time, very disciplined, consistently, and diversifying. That's it. That's what you should be doing. That's my opinion. Some people see investing or their philosophy about investing is go and buy high risk, make a quick buck, get out. I don't like that. Long time, risk, diversifying, consistency. That is my philosophy. And over time, I promise you, I guarantee you, the benefits of consistent investing, regular amounts, monthly, year upon year, in portfolios, unit trusts, whatever, in a risk profile that is ideal for you, is always going to lead to good wealth. Rian, plesier maat, I do my best, bud. Sean, there you go. Sean was here for a second, then Sean was gone. Hold on a second. Sean, there we go. Afternoon, Sean says, afternoon. What is a preservation fund? Is it like a savings account or like an annuity? Sean, it's like neither, to be honest with you. So, A preservation fund is if you've got a pension fund or provident fund with your employer and you decide you're going to resign because you're going to go to a different employer. And now you have to move your funds from your current pension provident fund because your employer don't want to look after it anymore. And you move it and you go and park it somewhere. You're going to park it with an insurer, Old Mutual, Sanlam, Liberty. You park it with them so that there is no tax when you move from your previous employer to this preservation fund. There's no tax. And then the money goes into an investment, into this preservation fund, keeps on growing until you get to retirement. That's a preservation fund. And the preservation fund says we're taking over the rules from your previous employer, which means that if you should decide in 3 years from now, for some or other reason, you've got a crisis, you need to withdraw some money, they see it, the preservation fund sees it at that stage that you're only resigning, and then you get that opportunity to do withdrawal. So that's how that works. So a savings account is basically where you put your personal money in on a monthly basis. Unit trust, endowment, bank account, if you want to call that, where an annuity, a retirement annuity specifically is like a pension or provident fund where you save to retirement for your retirement. You can't touch the money before the age of 55, but because it's not through a company in your personal capacity, it's called a retirement annuity. And then after you've saved all the money, then we go into life and living annuities, which is when a retirement annuity gets converted from where I'm saving in it to where I'm taking the money out and I start getting an income from it. Hope it answers it to you, Sean. Okay, Kitso, I got yours. Shane, what do you think about the Market Link account? It gives 9.4%. Is there something better? Shane, so I'm not sure which Market Link account you're talking about because there's a number of banks, investment companies that's got either portfolios or investments that they call a Market Link account. Now, I would think if you say 9.4% that this must be a bank account. So is there something better? Yes. If this Market Link account is a bank account, there's plenty that's better. On your 9.4%, depending on how much interest you earn, if you earn more than 28.5%, 28,500 in interest, everything above it you get taxed on. So if you then go and do the calculation, I got my 9.4%, but I got 100,000 Rand in interest, now I have to go and pay tax on it, you end up walking away with 7.5%, 8.5% real return. The rest is going to tax. There is portfolios that I have talked to people about on a regular basis, global portfolios, local portfolios, that on average gives a return of 9% to 14% on a year-by-year basis. And that 9 or 14% that you get is after taxes has been taken care of on your behalf by the portfolio manager in the investment. So I'd rather go for something like that where I get 9 to 14% return on my investment. And I know that what I get is an actual return. I don't still have to pay tax. Okay, Shane, I hope that answers it for you, mate. Let's see where we're going with this. Sarah, which platforms do you prefer? Okay, so I really enjoy Old Mutual Wealth's platform. Number of reasons, great funds that they use. Cost from what I have personally investigated is substantially lower or mostly lower than other companies. I like Allan Gray very much. Allan Gray, I think, has got brilliant products, and the cost as well when you do direct investment, I think is pretty good. Marriott, I like Marriott. I like their philosophy with regards to how they put their portfolios together, and they've always got consistently good returns on the investment. And then there's a couple of alternative investments that I also like. For arbitrage and livestock funds and so on. But yeah, my top three, I would say, would be the Old Mutual Wealth, the Allan Gray and the Marriott platforms, and then close on that will come something like Sanlam. Ivred, thank you. I'm grateful. What is the best business book for a start? Yo, mate, that is... Let me see. Let me just go. What plans? Okay. What is the best business book for a start? So you've read, man, I've read, I think in the last year, last 14 months, I've most probably read about 40 different books. So how do I tell you which is the best one? Because I think for every person, it's almost like investing. For every person, there's a different book that's going to work for you. So I tell you what, you Fred, go to my profile. Okay, there's my WhatsApp number. And all you do is you send me a little WhatsApp saying it's you, Fred, here. Please send me the list of books. And what I'll do is I'll send you my list of top 15, top 20 books. I've got one here. I've got a list here that I call books for beginners, which I very often give to people. And I think it's a list of 16 books where I say to people, go and start with these. And it's books as I've read them that I felt, listen here, this has worked for me in terms of getting me to grow as a person and grow my business. Not only that, but grow my family in terms of our relationships, grow my body in terms of my health. So go and send me the WhatsApp. I will send you the list of books with the greatest of pleasure. Kitso, do you advise someone to start with debt? No, never, Kitso. Debt is the biggest evil when it comes to the average person, average investor. So if you can have the financial discipline to start budgeting and to start saving money the way one is supposed to, there's that principle of 20, 30, 50, where they say when it comes to your income, 20% should be saved, 30% should be 50% should be for your basics. Your basics being where I live, how I get to work, and what I eat. 30% would be for the other stuff. 20% I have to put away. As a matter of fact, most successful people only use 50% of their income. The other 50% just invest. If you can start doing that and you can start saving and discipline yourself to save, to go and buy the business suit that you want to work with cash instead of opening an Edgar's account. If you can go and buy yourself a small car that you can get to work and back instead of making debt with financing. If you can do stuff like that and you can discipline and coach yourself never to have debt in your life, you will be one of the richest people ever. I promise you. You will be rich because you might not make millions or you might not have millions in the bank, but you will always have peace of mind because you don't have debt. So no, I never advise people to start with debt. And I know there is especially when you get to the property guys, they always talk about now get a bond paid off, rent it out, let somebody pay the bond. I don't agree with that. So no, I would never advise anybody to start with debt. What's your thoughts on gold? Good short-term investment. Saw this site, SA Goldbit. My thoughts on gold is that gold is as risky as anything else. There is times that gold is brilliant, and if you start understanding the markets and how the world works and how things are going, you can start identifying trends as to when gold should do good and when gold is going to do badly. But, and this is the big but, if you do not put in the effort to understand the trends with regards to gold and you just buy gold because people say it's fantastic, I think you will burn your fingers. I am not the biggest fan of gold as a investment because of the risk that's associated with it. So if you look at last year what gold's done, man, it's been fantastic. But then if you go and look at, I think it was the last month or two of last year, gold took a serious nosedive and people were crying about what their gold was doing. So gold is for me like anything else. There is a certain amount of risk attached to it, and if you don't understand the risk, you don't understand the trend, and you just buy it because your buddy told you to do it, you might burn your your fingers. And it goes for basically any time of investment, any type of equity. If you understand the trends and you understand when something goes up or when something will go up and something go down, then you can start becoming more specialized in your investing. But if you do not have that knowledge or have not learned those trends, it's much better to go and give it to somebody, like I say, a portfolio manager, and say to them, you look after my money. You're the guy that has studied this. You're the guy that's checking the markets. That's what you like doing. You do that, I'll go and do my job. I will go back and sell the cars that I do, go and do accounting, whatever. Okay, HB. Ade, do you think CRF for local government is a good pension fund? I'm not 100% sure which is the CRF, mate, to be honest. I know there's a lot of acronyms that we use in our industry, a lot of abbreviations, but I don't know all of them. So maybe you can just put in here quickly what CRF is standing for, and then the light bulb might go off and I'll be able to give you an immediate answer. Jannie, hallo, ek gaan af op 55, is 'n level pension reg, het 37 jaar diens. Jannie, nee chom, nee. Ek sal nie sê jy moet 'n level pension vat nie. Hoekom sal ek sê jy moet nie 'n level pension vat nie? So ek weet nie hoeveel geld jy het nie, Jannie, maar kom ons sê jy gaan R10,000 'n maand as pensioen kry en dis al wat jy gaan kry. Jou R10,000, as jy op hierdie stadium R7,000 'n maand uitgee aan jou kos en jou verblyf en jou dit, dat en die ander jou uitgawes, dan kry jy 10,000 en jy kan 3,000 gespaar want jy gebruik net 7,000. Maar volgende jaar gaan jy vir dieselfde R7,000 so goed, gaan jy moet R7,500 betaal want inflasie het dit opgestoot, maar jy kry nog steeds net jou R10,000. So nou kan jy net R2,500 spaar. En so gaan dit aanhou gaan totdat inflasie opgevang het, laat daai R7,000 se uitgawes ook na R10,000 se uitgawes en nou is jou break-even. Dit wat jy kry, dit gee jy uit. En dan daarna, dan begin die probleme. Want nou gaan jou inkomste elke maand 10,000 bly, want jy is nog steeds op 'n level pension, maar in die toekoms as gevolg van inflasie, gaan jou uitgawes 11, 12, 13, 14, 15,000 rand 'n maand word. So jy gaan jouself onder ongelooflike pressure sit. Dit is my opinie. Die enigste tyd wat ek sal sê iemand kan gebruik maak van 'n level pension, en veral vir jou wat 55 is, jy's baie jonk, chom. Jy het nog baie jare voor jou, so jy moet baie kapitaal hê. So vir iemand soos jy, as jy R10,000 'n maand se uitgawes het nou, dan sal ek nou vir jou sê, nee, dan dink ek moet jy R40,000 'n maand as 'n level income kry, sodat jy R30,000 'n maand kan spaar, sodat oor 20 jaar, wanneer hierdie twee goed met mekaar opvang, laat die kapitaal wat jy opgebou het, met jou geld wat jy gespaar het oor die jare, kan begin aanhelp, sodat jy 'n verhoogde inkomste kry. So Jannie, nee, net op die oog af, ek nie te gunste daarvan nie, maar verstaan dit asseblief, alles wat ek hierso vir almal sê, is my opinie, en dit is broad form advice, dit is nie spesifiek nie. Die enigste manier, Jannie, wat ek vir jou definitieve antwoord kan kry, is met jou sit te gesels, uitvind wat jou behoeftes, wat jy nodig het, en dan kan ek vir jou eers 'n ingeligte opinie gee, nadat ek vir jou 'n paar sommetjies gaan doen. Okay, Jannie, ek hoop het help, chom. Shane, Standard Bank, yes. Okay, so Shane, no boy, my personal opinion, that 9.4% is a bit of a waste. You must have a substantial amount of money invested in there to get a 9.4. They don't give 9.4 to everybody. But I honestly think you can do much more better than that. Especially taking into consideration the tax implication. Okay, damn, 14% after tax. It's very nice. Yes, kids, how it is. It is, and people don't believe it until I show it to them. Lies by Kroon. Hey, Mars, hoe gaan dit met jou? Hey, ons het vandag van jou gesit te praat, Mars. Jy sal my glo nie, ou wat ek gaan sê, net bly in 'n kompleks reg langs jou. Amazing. Dankie, Mars, waardeer dit. Okay, Riley, oops, daar gaan Riley. Riley was here and then Riley was gone. Ding, let's see, where are we now? Shane, so I'm new. And then if you, oh, so Shane, a global portfolio is basically what we call an asset swap. So you take your money, invest it in an investment in South Africa. The investment company takes the money, they take it international, they invest it on international markets. And when you want your money back, they take the money, they bring it back to South Africa and they pay it out to you. So whatever growth you got on that side, you earn the growth there. And then if the rand weakened against the dollar, then you get that rand-dollar exchange rate as well. So that's as simple as it is. It's called an asset swap. From an offshore perspective, do you prefer a sinking fund or a life insurance bond? Cyril, I'm not going to be able to answer this one for you, mate. Purely because I don't deal with those direct international investments on a regular basis. What I can tell you is that I would prefer, just on the basics that I know, the sinking fund, because it is an endowment investment. Okay. Do I trade? No, Mr. Klonky, I do not trade. I want to sleep peacefully at night. I don't want to have headaches and get heart attacks. So no, it's way too much, too much headaches to my liking. You want to start a small business and investing in portfolios that have more than 10% return. So Kitso, the only way to give you those things is to sit down with you and explain to you. There's a number of them that gives better than 10% return. But once again, it's all linked to a certain amount of risk. And you must understand the risk and see if you can take that risk before you invest in it. Everything in life, if you want to build a big business, you have to take risks to build a big business. If you want to have a good relationship with your wife, you have to take risks in order to get that wife. If you want to get good investment return, you must be willing to take a certain amount of risk to get that. So you will have to contact me so that I can give you different portfolios, okay? Sean Mitchell. Gee, the whole 4 AM club is sitting here listening tonight. Could you explain endowment? Sean, yes. Okay, so I'll give you a quick explanation of what an endowment is. So basically, things start off by buying shares. If you go and buy shares from Sasol, you buy Sasol shares and you invest it in that company and their shares only. So then, if you say, I don't want to just have Sasol shares, I want to have Harmony Gold, Amplats, Sasol, British American Tobacco, and you've got those different shares and you group them all together, it becomes a unit trust. Now you've got just a bunch of unit trusts or a bunch of shares that's in this pool, and that makes up a unit trust for you. Now, if you then add onto that a certain amount of cash, like a bit of a money market account, or maybe property, a property portfolio, and government bonds, those three, cash, property, government bonds, and you put that together with your unit trust, then you've got a portfolio. And an endowment makes use of portfolios most of the time. So I've given you just a quick breakdown to get to the endowment part, because on an endowment, what it says, if you've got a unit trust and you invest in a unit trust, you could put the money in, you can take it out, you could go backwards and forwards every day of your life. But on an endowment, you are restricted to 2 withdrawals within a 5-year period. Okay? So only after 5 years can you make regular withdrawals from it. So that's where the endowment differs from the unit trust, and it's because of the portfolios that you choose. The second thing is that if you've got a unit trust and you withdraw the money from the unit trust, then on the profit that you make, you're going to pay capital gains tax, if there's capital gains tax payable. On an endowment, the portfolios are taxed within the fund. The portfolio manager takes care of it for you, so that when you withdraw your money, it's after tax money, and you can then take that money without having to worry about tax again. So that is, I know I've taken a bit of a long way to get around to it, but it's because there's a difference between an endowment and a unit trust. And if you understand the difference between the portfolios and the unit trust, and then how they fit into unit trust and endowments, then it makes it easier to understand. Okay, Mr. Mitchell, thank you for the question, bud. Please explain what is units in my retirement fund. So Sean, units in your retirement fund is as follows. They cannot go and say to you, okay, listen here, mate, in your portfolio, you've got Anglo Plats and you've got Harmony Gold and you've got this, and you've got that, or whatever the case might be. So what they do is they work on a system whereby they say, instead of us telling you how much you've got 5 cents in this thing and 10 cents in that thing, whatever, they say, okay, in this portfolio, instead of pointing out how many cents or rands you've got in every share, we create a unit value, so to speak. So they create almost like I explain now with the unit trust, a pocket. I don't know how to explain better. And they say that is your unit. So if you invest your 100 Rand today and the units are sold at 1 Rand a unit, then you get 100 units. Tomorrow, the value of the underlying funds has increased. So tomorrow, a unit is not worth 1 Rand anymore. A unit is now worth 1 Rand 10 cents. So the next person that puts in 100 Rand, he does not get 100 units at 1 Rand. He gets less units because it's now 1 Rand 10 cents a unit. And in that way, they determine, as you put your money in on a monthly basis, how many units you actually buy. And that creates that when these units, you build these units, and then at the end of the day, when you've now got your 1,000,000 units in your investment, then they say at that stage, okay, so his units are worth 2.50 Rand a unit. For 1,000,000, it's worth 2.5 million Rand. But the first units he bought was only 1 Rand a unit. So he's actually made 1.50 Rand profit on that first unit. Hope it makes sense. It's a bit of a tricky technical thing that needs to be explained. Is creating a holding company good idea or just to trust to avoid a lot of bad things? So, Fred, it's going to depend on what you want to do, mate. If you want to protect assets, then a trust is most probably going to be the best thing. If you are interested in using the company to a certain extent for business, and putting assets in there and whatever, then a holding company could be a good idea. My personal opinion is that you create a PTY to do business in, and once it comes to personal assets that you want to protect against loss, and you want to leave a legacy to your family and to your loved ones, then you create a trust. Once again, different strokes for different folks. Oh, Wayne, you say CRF is consolidated retirement fund at local government. Wayne, I must be honest with you, I do not know about that. It might be possible. It might be possible that this is, it might be the pension fund that's being created by every local government. I don't know. At the end of the day, it shouldn't be a bad thing because it should be administered by an outside administration company. If that's the case, then not a bad thing. But personally, I have not had enough experience with this because normally when I speak to people in government, it's normally GEPF employees. So Wayne, sorry, I can't give you a straight answer, mate. Apologies. I have an idea on compound interest. Can you explain it though? Does my pension fund benefit from it? So compound interest is actually very easy to explain. Let's say you've got 100 Rand and you invest it and you get 10% interest. Then at the end of the year, you've got 110 Rand. If you leave that 110 Rand in your investment for another year and you get 10% again, then the next year you get 11 Rand interest, so you are now up to 121 Rand. So in the first year you got 10 Rand interest, next year you got 11 Rand interest, the year after that it's going to be 12 Rand 30 interest, and so it will just keep on going. 12 Rand 10 cents, 12 Rand 10 cents. So what it comes down to is you get growth on your entire investment. But what makes the wonderful thing that happens is that you get growth on your growth. You get now 1 Rand growth on the 10 Rand growth that you've already had. The year after that, on your 11 Rand growth, you get another 1 Rand 10 cents growth on that. Or 11 Rand 10 cents, sorry. So that's compound interest. It's growth on growth on growth on growth. If you're investing money in a bank, that's what they give you sometimes, because sometimes they give you what do I call it? It's not compound, it's called, can't remember. But sometimes they just give you interest. They say, we're going to give you 10% interest, but it's 10% every year on your capital amount. So you don't get the growth on the growth. You don't get the interest on the interest. So that's now based on your explanation. And with all investments with insurers and investment houses, they all work on compound growth, not compound interest. Because remember, with the investors and with the investment houses, you're not just earning interest like you are earning at the bank. You are actually earning growth, dividends, dividend growth, etc. on the shares that you're holding. So compound interest in the bank, compound growth in investment company products. Okay, advise a 20-year-old mortgage, bond or renting. Kitso? Okay, so my honest opinion is mortgage, bond or renting. Okay, let's put it this way. If you can afford 10,000 Rand on a bond, then you can most probably get the same place at 6,000 Rand rent. So I'd say go and rent the place at 6,000 Rand, save the extra 4,000 Rand, and build up a capital amount that you can go and buy that house cash, or where you can put down a massive deposit at some stage, and that your repayment to your bond becomes the same as your rent or even less. Okay, let's see. Global portfolios seem to do, but probably need the right one manager. Exactly, HB. Global portfolios are doing well, and Old Mutual Global Equity Fund, let me name them. Hopefully nobody gets upset with me. Has shown an average return of 14.1% over 21 years. Think about that. 14% every year for 21 years. It's good growth. That's why I like the that's why I like that portfolio. Sean, so new units can only be bought every month with my monthly contribution. Correct. Obviously, every time you invest money, whether it's a monthly or a lump sum, whatever, every time you put money in, you're buying new units. 100% correct, Sean. Hi, Donald, how's it? Tuba, is tax-free investments in unit trust good? It depends, mate. It depends on the type of unit trust that you buy. If you buy a low-risk unit trust that's only going to give you a 7 or 8% return, then that's all you're going to get. If you buy a high-risk unit trust and it gives you 12%, then that's what you're going to get. So tax-free investment, my opinion is it's good whether you are in unit trust or in portfolios. It doesn't matter. It matters more the unit trust or the portfolio you choose. It matters more how much risk you're willing to take for that little exercise. Opinion 191 value fund. Only problem I see is that there's only only one fund manager. No, I don't see that as a problem. There's lots of funds with only one fund manager. You must remember that when a fund has only one fund manager, okay, it's one guy sitting at the top that makes the final decision. But he's not the guy that does everything. That fund manager will have people that does research. He's got stockbrokers that advises him. He has got analysts that look at everything and analyzes everything. He's got people that goes and sits on the boards of companies where there's a big stock holding. So he's got a lot of info, a lot of input from a lot of different people that he has to go and analyze himself and make his decisions based on that, as to whether he's going to buy, sell, whatever the case might be. So no, I don't have a problem with the fund manager that only got with any fund that's only got one fund manager. Not at all. Simple interest. Thank you, Kitsa. I couldn't get that other word, the simple interest word, and now you've helped me out. I appreciate it, mate. Donald, what is the best company product to invest in? So, Donald, I'm not going to be able to tell you this, because if I tell you that I think it is 10x, then I am going to have 110 people telling me why Alan Gray is better, or Coronation is better, or Investec is better, or Old Mutual is better. There's a place for everybody in the market, because if there wasn't a place, there wouldn't be so many of them. So I believe that people have preference, and you have preference for certain reasons. People ask, Nana, which company I prefer? I said Old Mutual Wealth. It's because I trust them, because over the years, when I've invested people's money there and I said to people, we can expect a return of X, that's normally what the people get. When the person wanted to withdraw money, we could do it immediately. The costs, where they promised the cost is this, that's that. So you have people with personal preference, and you must look at that. And then once again, the different companies have different reasons to make them better. I might say to you today, listen here, I prefer Old Mutual, but you and your structure and what your personal circumstances might be investing your money in Discovery Invest. And I might not like Discovery Invest, but their product might just be ideally suited for you and might just give you the best. So there is no right or wrong answer with regards to the best company product to invest in. It comes down to a planning session and then advice from there. Dil, hi, where you from? Dil, I'm from Krugersdorp, mate. I'm sitting here in Gauteng. I operate from Krugersdorp. Although originally I come from the Orange Free State, where I grew up in a little town called Virginia. But I've been making Gauteng my home since I was 20 years old. Okay. Can pension upon death be transferred in a life annuity, ensuring my wife does not use all at once? No way. If it's a life annuity, okay, the pension, the income that's being received, will be received by your spouse based on the guarantee that has been built into that product when you originally took it out. But so the pension can be transferred depending on the guarantee. So if it's in the guaranteed period, yes, you will get it until the end of the guaranteed period. If it was a joint and survivorship, as they call it, then she will forever get it. So let me rephrase. Can pension upon death be transferred in a life annuity? Yes, the actual pension income will be transferred, but not the capital amount. Okay. That's on a life annuity, but it is dependent on what the guarantee is. Because if you chose a specific time frame for the guarantee and it's out of that time frame, then that pension is not transferable. Retrenchment can't contribute to my retirement fund anymore, so my amount of units will stay. Yes, Sean, that's fine. If you retrench, it means that your retirement annuity has gone paid up, but that's fine. If you leave it there, those units will not grow. You will not get more units, but your capital value in your retirement annuity will keep on growing because the units keep on. It's like shares. If you bought a share for 10 Rand to a share 20 years ago and that company is still on the stock exchange, it's very likely that their share price is now 40 or 50 Rand. So your units is the same as your share in terms of how it builds value. It just keeps on growing. So just leave it there, and it will be of great benefit for you at some point in the future. Bit of topic you say, if you try totally get off Eskom grid, is it viable? Heard of tax complications? Solar. Yeah, HP, there's benefits to getting off the grid completely. I don't know what tax complications you're talking about. I know there's tax benefits, there's tax incentives that's being offered by SARS if you do go the solar route. So I don't know about complications, but I know about benefits for going on solar. And I think in terms of solar on the short term, it's a major expense. But I do believe if you don't end up with too many hassles in terms of maintenance and fixing, whatever the case might be, over time, the solar will pay for itself and it will actually be to your benefit. It will become cheaper than being on Eskom grid. Griep, is crypto worth investing in Bitcoin and Ethereum? I can't tell you, mate. I am not the biggest fan of cryptocurrencies. There's a place for them, but personally, I haven't dabbled in it too much. I think crypto to me is still too young to feel comfortable to invest in it myself. Although I do believe that cryptocurrencies are slowly but surely getting to the point where they're like shares. The ups and downs, the serious spikes and declines, whatever, I think is pretty much out now. Cryptos are now very much bought on value. and not just bought on what do you call it, on the new idea and the profits and so on. Sean, it's only a pleasure. Ladies and gents, we've come to 7 o'clock. Let me see if there's one more. Okay, King Bob, I will answer you the last one. Hi, is multiple policies investments better than having just one? Whoa, man. It's a pretty difficult one to answer. And the reason why I say it's pretty difficult is, and I always use this analogy, if you've got 200,000 Rand that you want to invest and you put 100,000 Rand in this investment and 100,000 Rand in this investment, you've got your two investments, but you get 10% return on both. Then at the end of the year, you've got 110,000 Rand, so you make 10,000 each, you've got 20,000. But if it was one investment that you had, if it was just one investment of 200,000 Rand, and it was all in this 200,000 investment, you got 10%, then you got 20,000 return. So whether it was one investment or two separate investments, the return you get on investment is exactly the same. Okay, so from a return point of view, it almost doesn't matter whether you've got 1, 2, 5, or 10. I think where the thing comes in is with regards to diversification, is if you want to diversify your investments and not be, let's call it, stuck with only one company, then you would have more than one investment. And very often it happens that people talk to me and I advise them to go into investment with company A, but they've already got investments with company B and C because of previous advisors. And then I say, well, just leave those there. Unless there's any specific good reason to move it, we just leave it there and you end up with 3 investments, it's fine. It helps for planning in the future. It makes your options when you need the money more because you've got more flexible options. Ladies and gents, I do thank you as always for joining me tonight. I enjoyed chatting to you all. Have a wonderful evening and we'll chat again next week, Tuesday. All the best. Keep on. Bye-bye.